morning, everyone. Welcome to the Milken Institute Global Conference. It's a pleasure to have you here. I'd especially like to welcome our panelists. We're going to discuss rebuilding housing finance. Let me begin. I'm Ed DeMarco. I'm a senior fellow in residence at the Milken Institute's Center for Financial Markets. And to introduce our panelists today, I'll start down at the far right. We have John Bartling. John is the president and CEO of Invitation Homes, a Blackstone real estate portfolio company. And Invitation Homes has 47,000 single-family homes for rent across the United States and nearly $10 billion of investment. Seated next to him is Congressman John Delaney from the state of Maryland, first elected to the U.S. House of Representatives in 2012. He serves on the Financial Services and Joint Economic Committee. And prior to coming to Congress, Congressman Delaney was the CEO of Capital Source, and he is today the only former CEO of a publicly traded company in the House of Representatives. Seated immediately to my right, Nagendra Jayanty is a managing director at Claren Asset Management in the Carlyle Group. He specializes in real estate industries, structured products, and special situation investments. And prior to joining Claren Carlyle, he was a vice president at PIMCO, where he analyzed and traded non-agency mortgage-backed securities. Seated immediately to my left, Rick Lazio is a partner at Jones Walker, a national law firm. He heads the Jones Walker New York office in the National Housing Finance Practice Group for Jones Walker. He is a former U.S. Congressman from the state of New York. He also currently serves on the executive committee of the J. Ronald Terwilliger Foundation for Housing America's Families. And this foundation seeks to recalibrate federal housing policy to more efficiently address affordable housing needs and future housing needs in this country. And finally, to my far left, Phil Swagel is a professor at the School of Public Policy at the University of Maryland and a colleague of mine as a senior fellow at the Milken Institute. Phil was an assistant secretary for economic policy at the U.S. Department of the Treasury from 2006 to 2009, and in that position he served on the TARP Investment Committee and advised Secretary Paulson during the financial crisis. So again, welcome. What we would like to do today is we want to talk about where housing is and what progress is being made in the housing finance system today. You know, since the financial crisis took full flower in 2008, just to talk about a couple things that have happened with housing, certainly we've seen home ownership rates decline from their peak of nearly 70%. It's now down to about 64%. We've seen the share of mortgage finance in the United States that's backed by the American taxpayer, whether through FHA and VA or through Fannie Mae and Freddie Mac, has risen dramatically. It got up to about 90%. It's now currently 75 to 80%. We've seen some positive developments in housing. We've seen progress on data standardization, improved underwriting, the development ongoing of a common securitization platform. But we've had challenges, concerns over the implementation of new rules, government enforcement actions continuing today, and certainly the lack of action on ending the Fannie Mae and Freddie Mac conservatorships. So the goal of our discussion starting out, though, is while we are lacking congressional action on overhauling the housing finance system and bringing the conservatorships to an end, rather than focus on the policy issues there, our focus is going to be a little bit different, and that is we want to take a look at the landscape, legislative, market, capital markets, and so forth, to see what is actually taking place, what are new noteworthy developments. And the panelists here are each going to speak to things that they are currently involved in that are helping with the development of our housing finance system and really the rebuilding of this system. So to start us off, I'd like to start with Congressman Delaney to talk about a legislative innovation. While there are a number of bills that have been introduced the last few years on housing finance, I'd like to ask Congressman Delaney to talk about the bill that he recently reintroduced with his co-authors, Congressman Carney and Himes. It has an interesting mix of private capital and government support for housing finance, and with the government support has a rather unique feature of seeking private capital reinsurance to get a pricing signal. So, Congressman Delaney, let's start with you to talk about this innovation that you introduced.
Well, thank you, Ed. Thanks for moderating and for all your leadership in the government and your service to the country and your expertise in this important topic. And it's great to be here with so many very high quality panelists. So thanks for putting this together. So what we're trying to do with our legislation is lay out kind of a vision for how housing finance reform in the United States could look in the future by balancing a few elements that we think are really important. And to some extent, it's a response to the false choice we hear so much about when people talk about reform in housing finance. Some people say the government should completely get out of the housing business, that it distorts the markets, and we don't really need government participation. And while I'm sympathetic to that, I also realize that the U.S. mortgage market is the second largest fixed income market in the world, and it's never really had the environment where a lot of private capital could participate in it because the government really dominated the market. And I think a strategy or a structure that too quickly turns over the market to the private sector, I think, could really hurt homeowners and our country. And on the other hand, you hear people say that the government should stay engaged in housing in the same way they have historically and put the government in a position where they can put their thumb on the scale and distort markets. And those seem to be the choices we've been confronted with respect to housing finance. So we came up with an idea that I think balances those two options. In other words, takes the best from each side. And what we're doing is creating a way for the government to provide liquidity and capacity to the housing market. Again, a market of this scale, in my judgment, if we want it to be consistent, it has to have a steady buyer of the product, and I think the government's ideally positioned to do that, but also put in place a system where the private market will be pricing all the risk. So you have the government participation, but they don't do any of the pricing, and you have the private market price the risk. So the way we do that is actually pretty straightforward. So the best way for me to describe it is to think about a traditional mortgage securitization where someone is bringing $1 billion of mortgages to securitize, and these would be conforming mortgages. In other words, the mortgages that the government from time to time says fits the criteria in terms of LTV and size. These are the mortgages that Fannie and Freddie securitize today and have historically securitized. In our vision of the future, there would be a first loss risk capital, which is not a novel concept. We envision that being about 5%. There have been proposals tossed around by policymakers saying that number should be 10%. We think 10% is too high. We think probably 5% is actually too high. If you look at historical losses, even in the worst years, I think only once did we get above 5% losses. So we think 5% first loss is a meaningful amount of private capital. And then you'd have the government provide a guarantee for 95% of the capital structure. So in my hypothetical, you have $1 billion of mortgages that are brought to the market to be securitized. Someone would put up $50 million of first loss capital. Doesn't matter who that is. It could be any type of investor or guarantor. And then the government would provide a $950 million guarantee of the top of the capital stack, if you will. But what we require to do in our legislation, and this is what I think Ed was getting at when he talked about a novel or innovative concept, is we require the government from time to time to sell off at least 10% of its exposure in that 95% guarantee on a pari passu basis. In other words, on the exact same terms and conditions. So we're not slicing it or layering it. We're not creating kind of a mezzanine strip. We're simply saying in that securitization, if the government writes a $950 million guarantee, they have to find someone to buy $95 million at least of that exposure on the same terms and condition with the same risk profile. And however that person or that entity prices that risk is what the government then has to use to price its guarantee. So you basically create a market sourcing mechanism where the government on some regular basis, and we don't envision it being on a securitization by securitization basis, we envision it being more on a vintage basis, they're selling off at least 10% of their exposure on a regular basis. They're kind of fronting the market. They're the counterparty to the investors, so the investors never have to worry about whose credit risk. They always have the government's credit risk. But behind the scenes, the government is constantly offloading at least 10% of its exposure, again, on a pari passu basis, on the exact same terms, exact same risks profiles, what the government just wrote. And whatever the market demands for the pricing of that piece is what the government then has to use to inform its pricing. So we think it's a nice balance because you allow the government to continue to provide this capacity, and in the eyes of the buyers, there's no counterparty risk with the government, right? The government's obviously the ultimate credit, but you're forcing the government in a position where they have to actually be sourcing. And I think we'll all be able to look ourselves in the mirror if a structure like this were put in place, and we'd be able to say that the private sector is pricing 100% of the risk in housing, because obviously the first loss is private capital, and they're pricing the risk there. And this guarantee, which is mostly owned by the government, is also in part owned by the private markets, and their pricing discipline, which isn't always right, by the way. Private market will get it wrong from time to time, as we all know, but they'll probably get it right more often than the government will. Their pricing informs the pricing. So that's, I don't know if that's what you wanted me to cover there, Ed.
It very much is. Let me ask you one follow-up question with that. So in this structure, with regard to the second loss piece, the government's required to reinsure or sell off at least 10%.
At least 10%.
Can it be more?
It can be more.
How would you envision perhaps that even more would be?
Well, see, this is what I think will happen over time, and this is what I've been pitching people on, which is my sense of the private market is the private market likes a relationship with the government where they can kind of arbitrage the government. In other words, the private market gets one deal, the government gets another deal, and by the way, the private market likes it when their deal is better. So when you force the private market to share its deal with the government, which is what we're talking about here, and in fact the government will make more money than the private market will, because they have obviously lower cost of capital, and my sense is the private market will have to do a little more work relative to the government, because the government will have a lot more scale. What the private market will do, if they start liking this business, so if Berkshire Hathaway starts liking this business, or XL Reinsurance starts liking this business, or the other 10 reinsurance companies that get launched to pursue this market opportunity start liking this business, or the big banks, we put in our legislation that the big banks can be in this business because we think this risk, which is largely a AAA risk, is really well suited for the balance sheets of the big banks. If they start liking this business, they'll start allocating more capital to it, and over time, they'll want to buy more. Yeah. And they'll slowly, and it may take 20 years or 30 years, but if the private market can ultimately take over the market, it will through the structure, because the incentives are set up so that if they like the business, they'll want to do more of it.
Yeah. Very good. That's a fascinating construct and well worth some further consideration. Let me turn now to Rick Lazio. As the head of the affordable housing team at Jones Walker, what are you seeing as key developments post-crisis in the financing of affordable housing, both single family and rental, whether it's good or bad, and other sort of policy and marketplace developments that you're seeing?
I'd say sort of just to set the table a little bit first, Ed, and again, join the other panelists in thanking you for your leadership and your career. You're working over at FHFA and OFEO before that.
Thank you.
Remember OFEO, right?
I do.
You get the hives when you think about it?
Yes, a little bit.
6.5 years after the start of the Great Recession, the home ownership market is slowly healing. Still, you see some weakness in various areas, first-time home buyers, for example, which I want to relate back to rental housing and how well renters are doing later on. But there's a lot of stress on the rental side. Wages, largely because wages in real terms have stagnated or dropped. Median wages now are less in real terms than they were in 2007. Obviously, rents and costs of home ownership have increased. We've got 20 million American families now that pay more than half of their income in rent. 20 million. Another 20 million that are disconnected to opportunity, meaning they're living in communities where they don't have good schools, they're not near transportation, they can't get to good jobs. So you have 40 million American families that are in that spot. And while affordability on the home ownership side has improved, it has gotten worse on the rental side. And you're seeing that show up particularly on the affordable piece. So just by way of illustration, if I can, there was this year a condo, kind of a luxury high-rise condo in New York that had let's say 55 units set aside for affordable rents. There were something like 88,000 applicants for that. the last 10 auctions that they have had, or lotteries, not auctions, lotteries for affordable housing in New York City have, and I think they're about 600 and something units all in. There are about 486,000 applications. Staggering when you think about the scale of the demand and the need. So we've got a supply problem, we've got a demand problem, because obviously it's tied to income and it's also tied to the amount of supply. On the affordable side, the deals have become, it's a pretty stable market overall, but deals have become more complex, more needs for gap financing, no one piece filling that bucket effectively. So there's inefficiency in terms of the financing of these affordable deals. The primary tool for new production continues to be both private activity bonds and low-income housing tax credit that fuels about 90,000 units a year. And then we're going to talk about demographics later, and we're going to explain that really that doesn't even nearly begin to address the units that are falling offline. Over the next 20 years, we'll lose, have about 2 million low-income housing tax credit units that are at risk because they're falling off their compliance period. So a significant risk exacerbated in certain areas. A lot of demand for rental. Furman Center just did a study, 11 metropolitan areas. I think back in 2006, if my memory serves me correctly, there were 6 of them where there was a majority rental. Now there's 9 of 11 cities that are majority rental. And for those people who are on the market side of multifamily, you know that's been a very strong market. A big percentage of the overall starts are on the multifamily side, nearly 400,000, 350 to 400,000. Some markets are really hot, sometimes overheated. Cap rates are low. They're low for a lot of cash sloshing around for both market and for affordable units. Chase for yield, especially where there's a guaranteed contract, a Section 8 contract or something that it's bankable and provides investors a little bit more security. So overall, I'd say more complex, stable, adequate financing. Freddie and Fannie doing a little bit less than they had been on a relative basis, but still lots of money in the system, lots of people chasing deals, and very competitive atmosphere out there.
Very good, thank you. Some of those numbers are quite staggering. As you say, we're going to come back in the second question to talk more about sort of the longer-term trend and the demand for rental. But let me use this as a segue to John Bartling. And if we could have the third slide put up just as some background information. You know, a key development in the housing market post-crisis has been the focus on single-family rental. Many people may not appreciate that single-family rental was already a key source of rental housing in the United States, even before the financial crisis. But over the past few years, it has gained a lot more public attention, particularly with substantial private capital being brought into the marketplace as institutional investors are managing large portfolios of scattered site single-family rental. And the largest of these portfolios is managed by John Bartling and Invitation Homes. So let me invite you to describe what's going on in this market segment, its implications for where the market is trending, both in terms of meeting consumer needs, but also in terms of the capital market financing that's coming online to support this activity.
Thank you, Ed. I'm going to echo the sentiments as well. Thank you for all that you've done for our country.
Thank you.
Single-family rental housing, to me, is one of the most exciting investment classes in real estate today. We have 1 million new renters that have come into the market since 2007. While at the same time, home ownership has actually slipped down about 250,000. We're providing financial flexibility that really didn't exist in some ways at the level for which the fit and finish, the professionalization of the industry is really now coming together. There were 11 million homes before the financial crisis that were rented. Today, there's over 15 million homes today that are rented. Over 66% of people who are renting today are going into single-family rental. It's almost the same size as the multifamily industry, so give you some scale. What's interesting about single-family versus multifamily, just to give some context as well, is a very small percentage of the apartment industry, about 5%, is 3 bedrooms and above. Almost all of our business is 3 bedrooms and above. It's suburban. This is where America lives. We'll spend some time talking later on about who lives in our homes, because I want to give you some demographic information so that you have a sense of the quality of the residency that sits or that rents in our homes. What I would also say from a policy standpoint is the market's coming together fine. We're actually pulling together. We're seeing liquidity. We're not reliant on the GSEs. In fact, the GSEs do not finance our business. The securitization market has developed. Not over $9 billion have been financed over the last 2 years. At Invitation Homes, we're about $4.1 billion of that market. We see that continuing. The first multi-borrower securitizations have just come to the market, which are lenders, non-banks, who are actually now trying to provide financing for smaller owners and operators of single-family rental. We think this is a great trend. We love the liquidity that these lenders, we have a sister company, B2R, is starting to provide to the market. We do think there is a place, especially in the affordable housing area, for the GSEs to play. Many of the homes that are rented today are for those who are not as financially fit and maybe may more be challenged in terms of how they finance their properties. But this is an industry where only 1% of the housing stock is owned by the top 5 owners and operators, including ourselves. Only 1%. Of the homes that have been acquired by professional owners and operators, most recent information is about 500,000. So you can see it's a very small percentage of professional and institutional investors that own the market. It's very important for the development of this industry that we have continued liquidity, and so it's very exciting to see these most recent developments, especially with securitization, come to bear in the industry, because we think it is a real piece of the solution for providing housing policy.
Right. I think that's an important point, right? I mean, in a country this large, in a $10 trillion single-family market, and then another trillion or more in rental, there are multiple avenues and vehicles for providing both housing and the financing for it. So let's continue with financing. Let me turn to Nagendra, talk about capital market developments here in terms of financing housing in the United States. And let me start with one particular thing. Investors certainly appear to be enthusiastic with the GSE risk transfers that have already taken place the last few years. Several approaches, several types of execution have been brought to bear in the marketplace. They're continuing to refine that. So describe from a capital markets perspective, how are these deals trading? What are investors in the marketplace looking for, and what are they seeing as opportunities here?
Yeah, well, I'll start by thanking Ed for his service, because he's the one who really started the risk transfer from the GSEs, so thank you for that. We're optimistic on the risk transfer market going forward. It's really been accomplished in 3 main ways thus far. The first is outright sales of non-performing loans. We've seen that Freddie Mac has sold about 2.2 billion loans thus far. Fannie Mae just last week or a couple weeks ago announced that they're going to start program selling of these loans, and that's obviously going to be a big source of risk transfer going forward. The second is in pool insurance. So it's where the GSEs offer, or mortgage insurers take on a certain dollar amount of loss on a pool of loans backed by the GSEs. And that's only been about $1.7 billion, but I'll get to that in a second. We think that could be a larger source of risk transfer going forward. And the third is in these credit risk-sharing bonds that you started. That market has really been well received by private market participants. Since Ed began the program in 2013, the GSEs have issued about $16 billion worth of these notes. And while they're right now referencing risk on very high quality loans, high FICO, low LTV, that will likely take a low amount of loss, each subsequent deal that has been issued is ceding more and more risk to the private sector, which is positive. We've also seen a broad array of investors invest in these deals. So early on, especially in the senior tranches of these structures, it's been mainly money managers, that we have seen insurance companies, banks and credit unions, as well as some REITs. And in the subordinate tranches, it's been really dominated by hedge funds, that we have seen money managers start to pick up interest in those as well. And I'll get to why that's important in a second, to follow on some comments that the Congressman made. And so we see pricing is also coming down. You know, at the beginning, the senior tranches were trading somewhere around a 425 basis points over swaps type spread. That's come into about 350 basis points, roughly speaking, right now. The subordinate tranches are funding around 1,000 basis points. We see that likely to come in with all the demand we're seeing. And so this should be a large source of risk transfer going forward. The other place that we may see a more prominent role is in mortgage insurance. So there were a lot of questions after the crisis about whether mortgage insurers could actually pay their claims as they came due. To that end, the GSEs just last week finalized a new set of more stringent capital requirements to ensure that mortgage insurers are better counterparties through the next downturn. And so the next natural progression for them is to offer deeper coverage. So instead of insuring the first 25% of losses on a loan, maybe they move up to 50%. And we think from our conversations with mortgage insurers who we've been invested in that that's very likely. It's just dependent upon the GSEs and the FHFA to kind of take up this new avenue for risk sharing. The last thing, I just want to touch on some comments that the Congressman made about private capital. I think it's true that we need to be, while all of this is great, we need to be honest about the limitations of private capital as well, especially as it lies in the spectrum of keeping low and affordable mortgage rates combined with laying off risk in front of the taxpayer. So private capital suffers from three main flaws fundamentally. The first is that it's pro-cyclical. There's an overabundance of it at a very low cost in good times, but the exact opposite during bad times. The second is that it's discontinuous. So the mortgage market needs liquidity, as the Congressman noted, to fund every single day, day in and day out. And, for example, if the subordinate tranches won't be funded by hedge funds of these risk-sharing deals, the deals just won't fund, and we won't be able to lay off that risk. And the third is that private capital, right now anyway, is insufficient as it relates to low and affordable mortgage rates. So what I mean by that is, if we look at the top 25 banks globally, public banks, I mean, their market capitalization combined is about $3.4 trillion. But the GSEs have $4.5 trillion of risks that they insure. So I think that, if we look at, I'm throwing out this number, it's a random number, I've done no work on it, but let's say the first $75 billion of private capital comes at a low and affordable rate. Every incremental dollar above that is going to come at a higher and higher rate, which will translate to higher borrowing costs for home buyers. And so I think policymakers need to understand that there's a trade-off that occurs there, and I hope that that debate continues.
Yeah. Thank you, Nagendra. I think those are really some important points. And if I might add my own sort of observation about a couple of them, I think one of the things that's important to mitigate some of these sort of limitations of the private market is in terms of the disclosure regime and the standardization of data that is made available to investors. So if you compare sort of pre-2008 to what might be sort of post-2015, I would hope that we have a securitization world for residential mortgages in which investors can have standardized, reliable loan-level data so that some of the disjointedness or the sort of market evaporation that can happen when there's a disruption in financial markets could be mitigated, and you'd have less of a buildup of risk if, in fact, all market participants, in essence, become their own rating agencies. Anybody with a computer and a mortgage default model can be assessing the development, the incremental development of credit risk in the mortgage securitization world. I think that's an important part of what we're doing and trying to build for the future. So, Phil, let me turn to you to maybe bring a number of these things together. Nagendra talked about sort of temporary disruptions. The Treasury Department in their white paper several years ago, that was basically option 2 in their proposal, was to have a ready source of liquidity as opposed to an ongoing source. But just generally, in terms of any regulatory or policy developments or reactions to what we've heard.
No, absolutely. And let me bring that together with the policy and some of the market developments. Because my sense is the system is functioning, but it's not functioning as well as it could, and the policy side is really the prime culprit right now, right? So mortgage rates are low, and yet the supply of credit is pinched, right? So taxpayers are at risk, and yet the people who, especially affordable housing advocates, want to have access to credit still find it difficult. And at the same time, the market innovations are being held back by the dominant role of the government. And so it's kind of this weird situation where the system works, but not satisfactorily to anyone, really. And what's striking to me, as I observe it, is that many people expected Ed's departure to lead to changes, right? When the new regulator was brought in as a distinguished member of Congress and sophisticated understanding of financial markets, and in some sense right, I don't think it's a criticism. I think it's just a statement of fact that the FHFA director has disappointed pretty much everyone, right, from both left and right. And from the left, right, people expected a real push on broader access to credit. I think have been disappointed, right? He's done some things, but not the fundamental changes that I think people expected from the left. And you know, the sense which I think that's good, but right. I mean, so look at like the 3% crazy loans, right? The sort of, you know, everyone agrees is, you know, an odd idea given our recent history. You still need the originators to make those loans to be willing to do 3%. Originators saying, oh, we're not so sure. The G fee, right? We just last week, at the same time as the PMI capital requirements came out, there are changes in the G fees, which the FHFA's own message was, this won't matter. Right, so there's a huge amount of effort going into things, and maybe they're an improvement, but it really is a very modest improvement in any direction. And what's striking to me is that you have other ideas, right? You can take Congressman Delaney's pricing mechanism. They could do that now, right? And there's no substance. If you can imagine, if the government had a vision for moving the market forward, they could do those things. And if there's my vision or someone else's vision, at least move the market forward and not have it stuck where it is now. So that's, to me, that's the challenge, is bringing in the private capital. It seems like it's there, but making the system work better and giving certainty going forward.
Very good. Thank you, Phil. Before we move on to talking about demographics, let me just invite any of the panelists wanted to make an observation about anything they heard from their fellow panelists.
I'll just make one comment, and this is around GSE reform. Because of the magnitude of the potential consequences for change, having enough flexibility in the system where you could stop and pause and recalibrate if it's not going the way you'd expect it was going is an important component. So there is, I mean, what we're doing right now, which is nothing, you know, is well, I guess we may talk about that later, but it's got lots of negative consequences. On the other hand, going overnight into a new regime with uncertain outcomes is also a high risk given the magnitude of the market.
Yeah, no, I agree. And this is actually one of my observations on the Treasury white paper from, I mean, it's like 1800, I think, is when they put it out. Right, they laid out 3 separate options, but I looked at those options as points on a line, right, that the system now is, you know, very heavily dominated by the government, and as the more private capital comes in, we would transition from their option 3 to their option 2 to their option 1. And so in some sense, I would say anyone, sort of my friends to the right of me who want, a fully private system, I say, okay, I understand that. But to get there, you're going to have to formalize the government guarantees that you could shrink it. And I would just, so I agree with what you just said, that at some point, if the cost of mortgage capital goes up by too much, we're going to stop, right? I mean, every member of Congress is going to stop and say we're done, and that's right. We should do it incrementally.
So let's turn now to more of the future and where things may be headed. When we think about our housing system today, it's rather striking that some of the key institutional players, in fact, were created by the government in response to the Great Depression. The last time we had a significant disruption nationwide in housing. So you think about FHA, Fannie Mae, the federal home loan banks were all part of the legislative response to that system. So to give Congress some credit with regard to the difficulty of legislating in this space, this isn't something trying to fix a problem and okay, now we're good, or this is good for a couple of years. This is really long lasting in terms of what major housing legislation would be. So if you think about what's going to be done legislatively as having a long-term impact on the legal and institutional arrangements for providing funding for housing in this country for the next several generations, it's worthwhile to stop and think, well, what are these generations going to look like? Because, in fact, they're not going to look like the generations that have preceded them. Demographic changes in this country could have really profound implications for the demand for housing, for the type of housing finance that we might have. So I'd like to turn the panel to that topic now. And if we could go to slide number 1. Rick, I'm going to start with you. You serve on the executive committee of the Terwilliger Foundation for Housing America's Families. Demographic changes are a driving set of factors behind the work of the foundation. Tell us about how you view some of these changes and the implications they have for the marketplace and for policymakers.
I'd say, Ed, there's four buckets that I want to just quickly, because we don't have limited time. I want to talk about singles, I want to talk about minorities, I want to talk about millennials, and I want to talk about the baby boomers. Those are the four cohorts that I think have implications. And I think we're at an inflection point, candidly, for housing. Let me start a bit with singles. In 1940, about 7% of single people lived alone. That was a time when women largely lived home until they got married. Men got married earlier and started families. You didn't have the divorce rates, obviously, that have grown exponentially. So now you fast forward to where we are now in 2015, and the number is over 25%. So it's a 3.5x increase in the amount of singles. The housing stock was largely built for traditional families. And so in a world where more people are living alone, there is a significant challenge in adapting to that demographic, that more people, guys are getting married later, people are often not getting married at all, having children, staying single. They've got lots of different lifestyle options. That's one point. And the size of the houses in construction, because the luxury piece of the market is still hot relative to the, let's call it the middle class, where middle class demand is. I think over the last 20, 25 years, the size of houses have increased about 900 square feet as there have been more demand for singles. And so you got some cities like New York where 57% of the residents are, of the renters are singles. That's the first thing. The second thing are the millennials, those born classically over 1980 that got hit worse in the Great Recession than other cohorts. They're in terms of real median wages back to like sort of the averages of the 1970s, not for that particular cohort, but for parallel cohorts. And so they got hit very hard. They were a big part of the production before the Great Recession in terms of demand for housing, and they dropped off in half. So you had maybe 1.2 million younger people coming online. That number dropped between 600,000 and 800,000 during the years of the recession. Hasn't really come back. Again, the good thing if you're a home ownership person would be that eventually they will come back into home ownership. There's a sense that they want to own a home, but for the short run, they're increasingly urbanized. They want to be in multifamily housing. They want to rent. They want to rent in places where they've got lots of amenities. Bars, restaurants, cool places, cities, lots of people in gateway cities, obviously. The third major thing, which is this slide up here, is that you see a rise in diversity, with a large part of the significant demand for new housing over the next 20 years going to be driven by minorities. 70-some-odd% in this decade driven by minorities, and then an astounding 88% in the period of 2020 to 2030. Driven by minorities, Asians, African Americans, Hispanics obviously driving a large part of that. A lot of Hispanics in single-family homes, but lots of people in multifamily homes as well. The challenging policy question for this is that these renters traditionally have lower incomes and lower net household wealth. For example, average African American net household wealth is about $11,000. That's about 13 times less than the average white household family. If you look at it from a renter standpoint, that's overall all folks, both home ownership and rental. That number drops down to about $2,100. Hispanics about $4,500, and about $1,000 of that is liquid cash, so that they can put their hands on. It's got big implications in terms of the ability to come up with a down payment to be able to withstand various, even if you're in a house, different system failures and things that put shock into the system. So you've got a major issue going on as minorities driving the demand for housing, and disproportionately those folks are going to be, because of their financial situation, largely looking to rental housing to solve the problem. The last thing I would just say is the baby boomers. We've got the largest cohorts retiring now. If you look at studies, a lot of people say that I think it's 73 million baby boomers in the next 5 or 10 years that will be in that cohort, and another 9 million over 85. The issue there is, while many of them will say they want to age in place, those homes are not built for the elderly. They're not retrofitted properly. In many cases, people will want to live near the community, but will want to live in places that are more tailored to their needs. And again, this is not something that we're adapting to quickly, but it's a very interesting part of the market. A lot of private capital going into the subgroups of everything from assisted housing to skilled nursing and various subsectors within that group. So the country is largely getting older, getting more diverse, and a lot of pressure on rental. And if we have that other slide, we can throw up in a minute. You'll see that that things have flipped between demand for home ownership and demand for rental, with demand for rental expected to continue to grow into the foreseeable future.
Right. And so I think as people think about housing in this country and look at basic data, a typical metric that gets used is what's the home ownership rate. And for about 50 years, the home ownership rate actually was quite steady in this country. At around 65, 66%. It's currently at 64. And so what you just went through is really suggestive that the new benchmark or steady state, could well be less than that.
Could be less than that. And this is going back, where we are now is really kind of more the historical standard before there was a huge emphasis on the part of a couple of presidencies to boost home ownership. And it's entirely possible that you'll see home ownership levels drop down another 2 or 3 points.
Yeah. So let's turn, John Bartling, to you. The demographic and longer-term demand for single-family rental. We just heard from Rick about some of the bases for there being increased relative demand for rental. How are you looking at it in terms of the outlook for the market segment served by your firm? And perhaps we can put up slide number 4 for John.
So, thank you, Ed. So I may say 2 things. One is, I think in terms of rental housing and what it's complementing in terms of the overall housing policy is financial flexibility. Financial dignity is truly about having the flexibility. When you look at the cohorts today, whether they're the millennials who are coming into rental housing, by the way, they've had a high fit and finish on student housing because the private sector has invested significantly in it. They're going into urban apartments with a high fit and finish, and they're used to that flexibility of renting. They don't look at home ownership as something they need today. When you get into single-family housing, is that same fit and finish, that same luxury, is that same service that they're used to getting in single-family housing? You're now finding that with companies like ourselves, where you're providing those sort of services and that high-quality experience. And further in their lives, obviously, you're going to get into affordable, whether it's the senior housings or other areas. There's a large cohort who are actually now sitting there looking at, maybe it's 10 years later. It's not that it ever goes away for home ownership. We're not trying to replace home ownership. We complement it. We're watching people get married, as Rick said, later, and they're looking for far more financial flexibility. In large part, I think one of the things you find in our own portfolio, and as president of the National Realty Housing Council as well, we talk to our other member constituents, and here's a sampling of what you find in our portfolios today. Not many people know this, but actually our average resident is 40 years old. There's almost 80% of them are married. They have 1 to 3 kids. They have a pet. They're looking for a yard, and most importantly, they're looking for school districts. They tend to stay for 3 years. Very little turnover in our business, because once you're actually in that house, what you're looking for is a good neighborhood. You're establishing yourself, and over time, you may look to buy a home in that neighborhood once you decide that you're in that position or you want to be in that position. Many people are looking for mobility. They may be here for 3 years for their job. Jobs aren't like they used to be, where you stayed at one company for the rest of your life, especially with the millennials. We're finding they want that flexibility. Our average salary, as I said, is $50,000 to $75,000. This is in an industry where I think most people think that our people are in duress. Actually, about only 30% of their income is going to pay the rent. I should note that when people look at the affordability of housing, there's a lot of misnomers, I would say, because they're just taking a rent payment against a mortgage payment. Homes cost more. There's CapEx, there's roofs, there's replacement of appliances, there's HVACs, there's water heaters, etc. That upfront cost, that long-term cost, as most of us know who own a house, is actually more than is stated when you look at affordability. So we're providing that one-stop shop where you can rent and get your house, have a great experience, and 24-hour service, I might add. If you go over to our next page, just to have some fun, and to put our, since we're here in LA, I thought we'd just put up one last slide. Who lives in LA? Well, we actually have 1,300 homes, and I thought it would be fun just to put up here so you know who lives in our 1,300 homes in LA. They're 42-year-olds, they're married. Most of them have a college education. Again, they make $50,000 to $75,000. You can see what they watch on TV, what they like to do. Soccer, I know that's got to be a shocker because most of them have kids. I wouldn't have thought they read Spin magazine or that they go to BB, but this is who, and they drive cars like Jaguars and Infinities. So rental housing is a complementary piece of the housing policy. It's an extension, and I think over time what we're going to find is the pressure to home own is going to be less as the quality of fit and finish, service, and experience improves, and it will be a larger part of the overall housing solution.
Very good, thank you.
I just say I drive a minivan, and I'm
Yeah.
jealous here.
Well, if you rented, you could
Yeah,
have
exactly.
a cab.
Before the,
Yeah. I'm gonna show this to my wife, and we're gonna have a conversation.
I wouldn't do that. That also may be location.
So Congressman Delaney, let me turn to you. How do these demographic forces shape the thinking of lawmakers as they consider national housing policy? What are the things that come to mind for you?
So I think they're very important. Some of them are, some of them are not. I mean, the underlying trends that are happening with respect to the marriage rate, with respect to the growth in minority communities, et cetera, I mean, I think those are interesting. I don't think they really shape our policy around housing that much. There are a couple things that I think are really important for housing policy. One actually has nothing to do with housing policy, but it does indirectly, which is our immigration policy, right? Because one of the most important features of investing in housing in the United States of America is the fact that we have a growing population. And for people who own a lot of housing assets, the fact we have a growing population is a huge positive, right? This would not be the housing business it is if we're in countries that don't have a lot of immigrants and have birth rates that are not self-sustaining. You see very different housing profiles. So that's a really important, actually, housing discussion. But I think a lot of it comes to what are our priorities, because we have, like, for example, the home ownership rate was a target or a metric that people managed to with the view that that would produce certain results. Stable communities was often linked with home ownership rates. And I think a lot of data has suggested that there was, fairly significant myths embedded in some of these assumptions. Like the home ownership rate is not that relevant to stable communities, or not as relevant as people think it should be. We should have stable communities in this country, and we should try to develop metrics to making sure we're having stable communities and look at other areas of public policy that create stable communities. It shouldn't just be the home ownership rate. I do believe that as a matter of public policy, we have probably over-subsidized the housing market in general at the expense of under-subsidizing affordable housing, right? And I think we'd be better off as policymakers if we kind of came to grips with that, which is there are very compelling arguments, moral arguments, societal arguments, et cetera, for having a robust affordable housing policy in this country, which is something I'm very supportive of. And I think to the extent we subsidize all of housing, we are making a choice to not provide as much subsidies to affordable housing. And if we don't provide subsidies to affordable housing, there's a lot of downstream societal impacts that I'm very worried about. So that's a decision that I think we should make as a country, that we don't have to subsidize housing as broadly as we have. It's probably not as good for Americans in general to allocate as much of their income towards housing as they had historically. From a return on investment perspective, as John accurately pointed out, there's several things people underestimate significantly in this country: how long their commute is and how much it costs them to own a home. If you look at surveys that have been done where you go to people and say, how much do you think it's cost you to own your home over 20 years? And they look at their mortgage and their tax payment, and they throw in a little extra dollars for the other stuff, when in reality they're underestimating that other stuff by like fivefold. And so home ownership has not been as good of an investment as people think it's been. I think that the new generation gets that because they've seen so many people trapped, and particularly in a generation that wants mobility and wants flexibility. I think renting will appeal to them because that flexibility and mobility is really valuable. And you see a lot of people who are trapped in their house and they can't take a better job in another place because they're stuck in their house. So they're going to value mobility and flexibility. I think government should not try to encourage high home ownership for the sake of high home ownership. I think we should get if we're going to do subsidies, it should be really focused on affordable housing subsidies. And, we have to continue to have an honest conversation with Americans about they'd actually be better off taking more of their income and investing it for retirement or investing it in their kids' education than they have been investing it in their house. That's a really hard conversation to have with Americans because it's really changing the mindset. But I think the younger generation who's thinking very differently about what Social Security will look like in the future, is thinking much differently about flexibility and mobility. I think they're much more receptive to that kind of conversation. So that's kind of how I think about some of the demographics.
Very good. Thank
Can I
you.
just jump in? I just want to say, first of all, thank you for raising the immigration question because that is an important driver in terms of demand and, again, the type of demand that we'll have to confront. The other point is the federal government spends about $200 billion between tax expenditures and direct expenditures on housing. It's plenty of money. It's not the question is not whether we have enough money being spent on housing. It's how we spend it.
Exactly.
On the tax side, home ownership is favored over renters who, in terms of median income, make half of what homeowners make by 11 to 1. 11 to 1. There's more money spent, almost twice as much spent on the mortgage interest deduction as the tax expenditure than the entire HUD budget. So we're really out of balance in terms of the way we're addressing the need and the demand.
Right. I entirely agree with both of you. If I could add my own additional observation to this, in terms of the subsidies that we do have for single-family home ownership, these subsidies in some ways are less subsidizing being a homeowner as having a mortgage, because the subsidies are all driven at creating leverage on household balance sheets as opposed to what is true home ownership, which is equity. And so that's another feature of this discussion that really ought to be part of our policy debate.
And larger houses, by the way.
Well,
and financing larger houses.
That's partly what it drives,
Yeah,
is the outcome is to larger houses. So Nagendra, let me turn to you and ask, what opportunities do investors see in these sorts of demographic changes?
So I'm going to expand on what Rick said about senior housing. I think that's, we know about the millennials. We've been investing in multifamily to a great deal and continue to think that there's a shortage of that in the market. But, the 74 million baby boomers, this is a real issue, we think. So you have 48 million Americans over the age of 65 today. Over the next 20, 25 years, that number is going to go to 80 million. And right now, they're going to consume mortgages, and they're going to consume housing in a very different way. So senior housing, let's take that as an example. 21% of Americans over the age of 74 live in senior housing or assisted living facilities, and that number is obviously going to grow just because of demographics. We're producing about 20,000 units a year, maybe a little bit above that, and that's not nearly enough to meet what we think peak demand is going to be for about 40,000 units a year. And so it's no surprise that we've seen a lot of investor interest in developers and things like that. One of the best examples is in Pulte Homes, a national home builder. They have this senior community outside of Orlando called the Villages, and they've been selling 5,000 units a year. I mean, that's a huge number in the space. Single-family, single-story, heavily amenitized homes. Just a great example of the demand out there. I think on mortgage credit as well, the 65-year and older age bracket has an 80% home ownership rate. It's about 21 million households, but only 7.5 million of them have mortgages. So the question is, do they age in place, and do they take out reverse mortgages, or do they sell their houses for cash and buy new houses for cash? And does the overall amount of mortgage credit in this country decline? It's something to think about.
Absolutely. Thank you. Phil, let me turn to you about thoughts on these responses or academic research in this area.
Okay, sure. I was just thinking, in some ways, this discussion makes me kind of hopeful, because there's a sense in which it's a poor metaphor, but the frontal assault on housing finance reform last year, right, it got really far up the hill and then stalled. And, looking at the GSEs, but maybe there's progress to be had in other ways, right? I mean, tax policy was introduced by many people, immigration, there's training. I mean, some of the other subsidies we have, say, what used to be called Section 8 vouchers have a different name, but this is the demand side support for affordable housing. It's all super important, the low-income housing tax credit aimed at the supply of affordable housing, and maybe that's in some sense the next step or the better focus is, a useful focus going forward is all these things that will affect the housing industry, and even sort of GSEs will evolve and hopefully make progress, but take policy steps going forward in these other ways. That'd be really useful, actually.
Very good, thank you. Let me ask if anybody wants to comment, please. Yeah.
I have to say, I love the conversation, and I love what the Congressman said, because I think he's spot on, and I just have to reinforce one thing I said earlier. For single-family housing, if you really want to attack the Detroits of the world, the inner cities of the world, where the lower price points are, the harder housing, it's a ground game in single-family. It's a ground game. It's local. You want to drive local investors into the markets, and you want to help them to be able to finance their activities. That is one area that is a glaring hole in our current housing policy. Fannie Mae, Freddie Mac do not finance those for investors. Right. By the way, very liquid market if you want to buy it. Happy to finance it all day long. But for an investor to go in, and what investors do for neighborhoods, they clean up homes. They improve parks. Yep. They make those neighborhoods better. I would say that's the one area I would encourage as a policy standpoint that we really give a lot of effort towards.
Yeah. Very good, thank you. Anyone else? We have just a couple minutes remaining, so let me see. We've covered a couple of really interesting topics here in thinking about housing. Let me see if there's a couple of questions in the audience. We'll go quickly. Yes, please.
So there's a lot of talk about millennials and singles and their desire for mobility and flexibility, and single-family rental is clearly one of the options. Although what you give up is this kind of forced saving mechanism. I know, Congressman, you mentioned that there are better options, better ways to save, but the decline in home ownership is occurring now. Those other mechanisms are really just an idea at this point, right?
I think.
Actually, sorry, if I can just finish first.
Sure.
My question is really, though, if a second option I think is, and I think something that's really holding back millennials and singles is the high transaction costs, right? And which is, I know, largely a private market dilemma, right? With 5 to 6% to transact, then mortgage taxes and local taxes. I think that's just as much of an issue that holds back young people from buying homes if they think they're going to be in a place for 2 or 3 years. Are there any programs that are looking or interesting thoughts that any of you have with respect to transaction costs in the mortgage market?
I mean, I'll take a shot at that. I mean, first of all, to clarify, I was actually more simply saying that the data would suggest they would have been better off putting their money in the market than actually putting in housing. Not for everyone. I mean, there's certainly sub-market examples where things have gone up tenfold, like some of the most expensive New York City apartments, right, for the last few years. But that's more what I was getting at. Not that it's a terrible investment, but I just don't think it's quite the investment that people thought it was when you really look at the numbers. I think Rick made a really good point when he talked about how much when you look at the subsidy we provide as a country with the mortgage interest deduction, and then if you come up with the subsidy that's been effectively put in place with Fannie and Freddie over time, you get a very significant allocation of the precious government's treasure towards encouraging people to own homes. So I, for one, wouldn't be in favor of more incentives around transaction costs. I think if you really don't have that level of certainty that someone's, and this is not public policy, it's just more of an opinion. If you don't have that level of certainty that you're going to be in a house for more than a couple of years, then you probably shouldn't buy it, and you should rent unless you're viewing it purely as an investment and you have insight into the market and you think it's going to go up a lot. But it's probably not a good permanent long-term housing decision because of those transactional costs, right? But I can't think of any good reason for policymakers to create more incentives that are hard for us to pay for as it is to lower those.
I would just add two things. One is exactly right. People talk about the main theme of real estate investing is location, location, location. It's really timing. When you buy and when you sell. And if you've got to buy and sell in a short period of time, your returns, especially if you're a low down payment party in the market hasn't moved will eat them up. The second thing I will just make as an observation is it's remarkable to me that given the technology and the data available and the amount of people that are looking at websites for pricing and all that, that the price of brokerage fees has barely moved.
Yeah.
You know, and it's astonishing, really, that how close all the market leaders are in terms of their pricing, and so I think that's a
Very good.
challenge.
So let me, I'm sorry, we're out of time. We have to leave it there. I'd like to thank my panel for a wonderful discussion. Thank you, everybody.